Welcome to Stock Cheat Sheets, where we trend, rank, and grade stocks and exchange traded funds.
Connor, you think it's hard to press buttons, watch me pat my head and rub my stomach at the same time. It's worse. How you doing, Cole?
Doing pretty well. How are you?
Something's wrong with your mic.
Let's see.
It may be that you're just too far away because you're using you don't have a physical mic, right? You're just using your computer mic.
Yeah. Can you hear me now?
Turn up the input a little bit more.
Turn up the input.
And I'll turn up my volume. Talk to me.
Can you hear me now better?
Yep. Yeah, I can hear you now.
All right.
All right. So before we get started, since we're recording this just before 2 o'clock East Coast or 1 o'clock East, and yours and my New England Patriots, who did not look great last week, trying it again in game 2, what's your feeling very quickly about the game and the season? Like, do it in 2 sentences.
I personally think that they're going to win this game, but I don't have a lot of hope for the rest of the season.
Kind of too many holes. There's not very much offensive weapons.
Mm-hmm.
Yeah. So New England going through a bit of a drought year. And the stock market, bad transition, going through a drought year of its own. Last week, we rolled over right as the key economic report for the week, which is called the Consumer Price Index, where we were all expecting inflation to be much more tame than it ended up being. And as a result, the market lost hope for the Fed lowering interest rates, or at least stop raising them anytime soon. And so as a result, the idea of quote unquote pain that Jerome Powell had promised a month ago looks like it's going to happen. We crashed basically right after that report. And then we haven't gotten any back. In fact, we broke a key support level. And this is where we can start talking. I'm going to share my screen. And after the vortex from hell, I just want to make sure you can see the SPY on my Thinkorswim chart.
Yep.
Okay, great. So, Cole, on a long-term or even intermediate-term basis, is the market in an uptrend or a downtrend?
It is in a downtrend.
Yep. And what makes you think that? Give me a couple of reasons why we're in a downtrend.
Well, from these two lines you have, I forget exactly what you called it, but when the lows are getting lower and the highs are getting lower.
Yeah, the 2 lines are the 10 and 40-day exponential moving average, and they're the daily candles because I'm looking at a daily report. I could easily change this to the week, and we'd have candles that represent the weekly trading. And it's probably even easier to see the fact that this is how last week started. Mm-hmm. The top of this candle, we know that because this candle is red. And because it's red, it means that it started at a higher price than it ended up throughout the week. So you can see that we started higher than the previous week, and then we closed lower than the previous week. Can you see that?
Yep.
This type of candle is actually important to know. And you know what I mean by a candle? A candle would be a single element. This is called a candlestick chart. And this element here would be an individual candle representing a week. On the weekly charts, what do you think it represents on the daily chart?
A day.
Correct. So this is Friday right here. And then this is all of last week again. And so this type of candle is called a bearish engulfing candle. It is one of the candles where you don't need any confirmation to know that the path of least resistance in the shortest term possible, meaning follow through on Monday, is likely to be the downside. So a bearish engulfing pattern, when the stock is already in a downtrend, is important because what it's done is tell you that we had a previous move lower and then we tried to consolidate sideways. But on our second consolidation week, we ended up starting the week higher and we closed the week lower. So basically the body of this candle engulfed the body of the prior week's candle. And when that happens, usually it's at support and resistance or resistance. So it becomes more meaningful when it's at a key support or resistance level. It just so happens that I wouldn't call this necessarily a key support level, but it is somewhat of a level where you're going to be able to draw a line and get a lot of touches. And I'll show you what I mean here. I'm going to use a horizontal line and I'm going to start back. The more touches, the better whenever you're drawing lines between candles or above candles or below candles to make a point. So I'm going to kind of jury rig this a little bit to try to touch as many as I can. And I'm going to put it right about there. Now, remember, support and resistance is a range. It's never an exact line. Mm-hmm. So I might have drawn it here, but I'm really it's kind of a plus or minus area. Okay. So we had basically the market pulled down here to this line, and there could be other instances further back, but we'll just limit it to last April and forward. But we had a big downtrend last April. We bounced once, and then we had another leg down, and then we bounced, and we ended up bouncing and having the summer rally. Notice that in this case, this candle hit a lower resistance. This is a diagonal line, diagonal trend line. We bounced off that and kept right on going until we got to the downward version of diagonal resistance, hit our head on that, and went lower, and then bounced here and actually had a trade. We had a close above the high of the previous week. And I think you remember last week when we got together, we had a bunch of market forecast indicators that were starting to look a little bit more bullish. And I was expecting this week to teach you buy the dip. You remember that?
Yep.
Now, of course, CPI came out. We started the week with a lot of hopium. We're smoking a lot of hopium. And so we started the week Monday higher, and traders had really positioned themselves to the point where all the oscillators, and you remember what I said about the oscillators can't really predict. They're not fortune tellers, but they generally reflect what is commonly expected. And since they reflect acceleration rather than velocity, we were seeing an acceleration to the upside going into that CPI report that didn't pan out. You remember all that?
Yes.
Okay. So bearish engulfing pattern. We closed the week not only lower, but some would argue, and I have to go to the daily charts to show you this. Some would argue that we actually broke a support level. And what I mean by that is, now you kind of always have to adjust these when you're talking about different time frames. Mm-hmm. But if I were to activate this and kind of get the lines to touch, by the way, in technical analysis, recent matters more. So in other words, making sure we reflect the common touches closer to where we are today is more important than having these more recent ones match up. But it turns out when you look at this, it's a pretty good set of touches. Wouldn't you agree?
Yeah.
It's like support, resistance, broken resistance, which is unusual, and then a pullback retest, which is very common after a breakout, and then a move higher, hit our head on a different resistance, have floated back down, hit our feet on what was old resistance, now acting as new support. Up we go, making a lower high. It looks like maybe a 1/3 retracement. And then boom, not only do we put our feet here, but at high volume, and that's important. On a breakdown, you want to see two things. You want to see a definitive move lower below your support line, accompanied by better than average volume. Now, I don't have a volume bar drawn on here, but you can find one in Thinkorswim, and you can put it here. And you'll probably see between 125% and 150% of average volume. That's what this line means. It means that it doesn't mean they all went to the up or downside, Cole, but what it means is that 100 million shares, give or take, of the SPY traded hands on Friday, and the price ended up lower. So more sellers than buyers, but there was a high volume, meaning that there was a lot of conviction behind this move lower. Does that make sense?
Yeah.
High volume matters in trading. When there's a significant price move, but you're seeing a really low volume day, like this gap lower, although it ended up being, well, I guess actually this gap lower was on higher volume, higher relative volume. Then this down day, you notice how the volume was higher?
Yeah.
And on this down day, volume was higher.
Yep.
This down day, volume was higher. And this breakdown, volume was higher. What that pattern tells you is that, and this is kind of important, this is a way as a trader to kind of gain a little bit of an edge on other market participants. Uh-huh. If you notice that liquidation days have more volume behind them than what I'll call accumulation days, you know that the big institutional traders who make the market are probably sticking it to the retail. There's more retail investors, but they control less money and fewer shares overall. Whenever you see big volume and moves down, that's most likely the big banks, investment capital firms, and others with trading desks sticking it to retail investors who mostly want to just buy and hold and hope it goes up. Mm-hmm. And so short is definitely what I would describe the big institutions. And so this is a breakdown. So after a breakdown.
So wait, does this mean that like these big institutions are trading bearishly then?
Correct.
Okay.
Yeah, we think. Now I can't tell you for sure. I've only got two things to base that on. Well, really three. I've got the market forecast, which we'll get to in a minute. Mm-hmm. But the key things were the volume on the down days and the general direction of price. And now up until recently, we were making some higher highs and higher lows, but recently now we can say for sure lower high, right? Mm-hmm. Lower low. So on even a short-term basis, we are trading bearishly because this is a short-term trend, right? It's less than a month old.
Right.
So that's bearish. What about the intermediate trend? Let's look at that. So the weeks to months, nope, that's lower too. Notice that so the daily trend is lower, and where's the 10-week exponential moving average, and where's the 40-week exponential moving average?
The 10-day is below the 40.
This would be the 10-week now because I'm on the weekly chart.
Is below.
Yeah. So another thing that will give you a hint that we're in a downtrend in the time frame that we're looking at is the position of the two moving averages relative to each other. You notice how they got really close, even though that one was below the other, and they were bearish, right? Whenever the 10 is below the 40, we're bearish, exponential moving average. But you notice how price kind of made a move, and these two moving averages got closer together. You see that?
Yep.
So that's called convergence. You'll hear that term used a lot. In fact, there's an indicator called the moving average convergence divergence indicator. And it's a fancy name for saying that when that particular indicator is rolling up, which I'm not going to waste my time putting on the screen right now, it's telling you the moving averages are converging.
Yep.
And when it's going down, it's telling you the moving averages are diverging. So what's happening is momentum in the shorter term time frame is beginning to accelerate to the downside. And eventually that impacts the longer term average, and they start both pointing lower. And so it's that divergence that's just begun. I'm going to come in a little closer, but would you agree that these moving averages are now kind of moving apart from one another?
Mm-hmm. Yeah, looks like it.
And we also see that this moving average has begun accelerating its downward trajectory relative to this one, right? If we were to draw just the last day or two, that angle is steeper than that one, right?
Yep.
So all of those kind of things as a technician help you gauge the trend. I mean, I think the trend is pretty obvious. There's one other thing I want to share with you and with the audience, because it's so rare. We don't see this very often in trading, especially on a major index. I'm going to pull out you're probably too young to remember the movie Jaws, right? You ever watch that movie about sharks?
Yeah, I have seen it.
Okay. So even the kids these days have seen it. But there's a scene where the mayor doesn't want the sheriff to alert anybody about shark-infested waters because it's the holidays and he wants the beaches packed. And of course, the big bad mayor gets his way. The beaches get packed, much to the sheriff's chagrin. And of course, some little kid gets eaten by a shark. And that's one of the stories in Jaws. Well, the Sheriff Brody is using something called a bullhorn to warn people to get out of the water. The stock market actually has a bullhorn pattern, and you're seeing it here. And these are very unusual. And I guess you could probably see it on the weeklies. So let me come in and show it to you on the weeklies. Give me a sec. All right, there we go. No, I guess we need to show it on the monthlies. It's too big a pattern. There we go. All right, so bugle or bullhorn. See what happens? You've got the highs moving away from each other and the lows. See how they're kind of expanding, right?
Yep.
That is a bearish pattern. When it's pointed lower and you start to see price kind of bouncing off these edges, and as these edges are expanding away from one another. Now, sometimes price doesn't automatically make it there. There's a midway point that it'll sometimes bounce off of. But in general, key reversal points are determined by this megaphone here. So we can expect that if we kind of break this horizontal resistance, the next resistance is probably going to be this low here. But ultimately, it's not the lowest point that we could get to in this pattern. It's going to be, at some point, a good chance that we'll touch the outer edge of this lower line. It's lower diagonal line, which is part of a bullhorn pattern.
Mm-hmm.
Here's what's scariest about this pattern. You're going to learn a lot about technical patterns, whether I teach you or you read up on them or other traders mentor you. But this pattern is actually just a setup for what will be the breakdown. Assuming we break down, one of two things will happen. Either we'll break out to the upside, meaning price will get above this line. The more likely outcome is actually price gets below this line. And here's what's scary about this. Once price breaks below the lower part of the bugle, assuming it happens, and on high volume, again, you need that 125, 150% volume, you can measure the distance between the 2 points in the bullhorn to that point in time and extrapolate that on. And I'm literally will do this. I'll show you how we would do this. Let's pretend we're breaking down here below this level of 324. What I could do is I can go grab a shape, and I know you just got your toss charts, and you can extrapolate, first of all, by measuring the distance between those two bullhorn points here. I probably needed to make that a little bigger. Try that again. Here we go. So right here, and then I can duplicate this, and then right on the breakout point, put here and forecast a low. And here's what you're going to find amazing. And I promise I didn't do this beforehand. I project that if we were to break out here, that we'll hit this as the next low. I'm not saying that's going to happen, but if it did, that would correspond pretty closely with the COVID low. This was when the market crashed after COVID. Right here. Isn't that amazing how that ends up working?
Yeah.
So that's the thing about technical patterns. Now, of course, that would have to break down here, and it's more likely unless we have what's called a waterfall crash this week, hopefully this outcome is not going to happen, because that would be a devastating downward move. That would take us from 477 to that would be the market getting cut in half.
Yeah.
Could happen though. And so never say never. All right. So anyway, that's a technical pattern. Overall, I think we both agreed we're bearish in the long-term time frame, the intermediate time frame, and I'm just going to check the longest term time frame. Not yet in the monthly time frame. We're in fact still bullish. See that? The monthly. So a long-term, longest term trend is up, but the one we care about, longer term, lower. The time frame we like to trade in, which is the intermediate term, a couple of weeks to a couple of months, is lower, and the daily or hourly candles are also lower. They've been lower for a while, ever since the CPI came out. The market's been trading lower. So there you go. So what's ahead? In order for us to know, we have to kind of remind ourselves what the different time frames mean. And so I'm going to, for the benefit of those who didn't watch your first video where you learned this, and for my benefit, see how much you've learned, let's go through the market forecast readings. And then for those of you new to cheat sheets, I'm going to, I have to get it, but let me cross-reference cheat sheets. Here we go. That's a little hard to read, but you can at least read whether it's bullish or bearish here.
Yep.
Okay. So we'll tackle this in a minute, but let's start out. Remember, on cheat sheets, Factor's pre-trade checklist contains 3 forecasts. Why don't you tell me what they are? If I'm talking about the long-term forecast, Cole, factor number 7, what am I referring to?
Factor number 7, that's the intermediate time frame.
Nope. That's factor 8. Factor 8 is intermediate, and that's the screen line here.
Okay, so factor 7 is the blue line.
Actually, factor 7 is this orange line here, gold line.
Sentiment.
Yep, market sentiment. It's the longest term. Do you remember about what the typical time frame is? You don't have to be exact. It's more of a range.
Is it a year to 2 years?
It would be a months to years would be the way to say it. So 9 months to maybe 2 years. So roughly what you were saying. Yep. And then the next time frame down is the one we trade in. What's that one?
That's the intermediate time frame.
Right. And that's the green line?
Yes.
Yep. And so green line at 17 pointed down, how bearish are you? Are you bearish?
At 17 pointed down, you are very bearish.
And what if I were 17 pointed up?
17 pointed up, you would still be very bearish.
That's right. So below 20 in the what we, sometimes I'll refer to it as the opposing team's red zone. Other times I'll refer to it as our own end zone. Either way, we're talking about being in a position where there's more to lose than there is to gain by trading bullishly. So essentially, no matter which direction the line is pointed in, below 20, you are the most bearish for that time frame. Now, going back to market sentiment, the long-term time frame, are you bullish or bearish?
In the long-term time frame right now, we are bearish.
We are not. We are bullish.
Started pointing up, yeah.
Yep, pointing up. So we're above 50 and pointing up. So the market senior timeframes right now are really at a disagreement. They're saying eventually we resolve to the upside. And I don't mean that in the way financial planners say it. You know, financial planners will tell you, just keep investing a little bit every month and, you know, don't worry about the short term. You know, as long as you get 5 years to live in, you know, eventually we'll go up. And all that has been true, at least for the last 100 years or so. I know this is referring to the next few months, what's going to happen. And this forecast is saying that based on the trading activity to date, there's a better chance that before the end of the year to maybe mid next year, that could be the beginning of a reversal of fortune. That's exactly what that's saying. Now, if price continues to go lower, and this line, this what we call the long-term sentiment line, factor number 7 on cheat sheets, if that starts to say neutral minus, where would we be in terms of the position of the market? Would we be above 80? Would we be between 50 and 80? Would we be under 50 but above 20, or would we be below 20?
We would be below 80 but above 50.
That's right. So in fact, if this direction of this line changes, that's all that would need to happen, but it doesn't move anywhere. Let's say it's 59 and pointing lower. The long-term sentiment changes from what to what?
It would change from bullish or slightly bullish to slightly bearish.
Actually, it would be bullish to slightly bearish, right? Because above 50 but below 80, we're bullish in the time frame when we're pointed up, but when we're pointed lower, we would be slightly bearish or neutral minus.
Right.
Yep. Okay. And once we're neutral minus, it means that we would have multiple time frames of bearishness. So when the time frames agree, particularly the green line and the blue line, the green line and the gold line, when they agree, whether it's to the upside or the downside, and remember this one, this will both save you a lot of money and make you a lot of money. When they agree, the chances of the directional outcome you're seeking, as long as you're trading with them and not against them, are far greater than when they're mixed right now. Does that make sense?
Yeah, that makes sense.
Right. So right now, are these two senior time frame lines, do they agree or disagree?
They disagree.
And why do they disagree?
Because the market sentiment line is showing that it's bullish, while the other ones are all bearish.
Exactly right. Yes. All right. So you got that down. So remember that when you are trading directionally, and provided it's not day trading or what we call swing trading, meaning when your time frame is just a few days or only, you know, the same day, when it's that kind of turnaround, none of these rules apply. But as long as you're trying to ride a trend of a few weeks to a few months to a few years, this is true, that I always recommend, no matter which direction you're going in, whether it's bearish or bullish, when these two lines are not in agreement with one another, it's a good idea to cut your risk in half. So if you're used to risking, 2% of your trading account on any one trade, that you move down to 1%, whether you're short or long, cut your risk in half, and you'll save yourself a lot of money. You can still trade, but your gains won't be as big, your losses won't be as big. You could still, if you're really good at this, you could still generate a profit. You're just generating a better, what's called a risk-adjusted profit, if that makes sense.
Makes sense.
Okay. So with that as the background, and you did a good job, let's move to the junior timeframes. These are more what we call signal lines, where their position is less important in terms of you divining the overall trend moving forward. These act more like timing mechanisms, so they have a slightly different function. And so what we like to do is be in an established trend, one direction or the other. Now, we're not in that, but what we're going to do is, for the purposes of today's session, and quite honestly, the way I trade is I've got a whole bunch of stuff long-term invested where I'm hoping the market goes up. I have a smaller percentage of my portfolio that is that I invest in short trades. So this would be an advanced version of what I just said, that when we have markets like this, I have the stuff that I don't need to touch for 20 years, assuming I make it that long. And then I have the stuff that I want to trade because I want to make some short-term profits out of the direction. So that would be me. It would be not that I would be cutting my risk in half necessarily. It would be that with a portion of my portfolio just invested bullishly for the long term, I have a percentage, less than half invested in a short-term outcome. So I would look at this green line and say that for my active trading account, I have to make my market directional assumption based on the green line and not the yellow line. So that's how I do it. But understand, I'm still respecting that yellow line because I'm still invested in the long term. It would take these two lines to both get below 50 before I start lightening up on the long-term stuff in my portfolio, just so we're clear. Okay. So either way, though, you're doing something because just sit pat and just let the market go down without you at least making some money off the short side or protecting yourself from outsized losses. This is telling you, warning, this market is probably going lower. All right, so let's get into it now. The junior time frames, just a quick review. If you remember, I know we went through this really quickly. So if you don't have as much of a command of this, I understand. Do you remember the purpose of the blue and red lines? If you could summarize sort of how they impact your trading.
Yeah, I know like the momentum line is good in like either continuing or negating things in like the really short term frame.
That's right.
Yeah.
Yep. So when the momentum line is at an extreme, it's important to pay attention to it, and that shows up in cheat sheets as what we call bullish zone or danger zone. The blue line is similar, though it's a different time frame. When the blue line is making an extreme move in either direction, it's worth paying attention to. When it's not, and it's just sort of in the middle, it's perhaps a little bit less important, but not totally unimportant. All right. So what we want to do is we take our cues off of the two main lines, and then we wait for an extreme in the blue and red line in order to make trading decisions. Okay. I'm going to try to review those now.
Got it.
So why don't we, because cheat sheets is set up to support bullish trades, I'm actually going to flip the script on the market and choose a security called SH. SH is, you can read it in the upper left-hand corner. It says Pro Shares Trust Short the S&P 500. Do you have any idea what short means?
You're basically betting against the market.
That's right. And in this case, this particular short ETF is not leveraged, meaning it's not designed to deliver anything more than a one-for-one trade. So for every dollar the SPY goes up, this one would lose what?
$1.
Correct. And if the SPY goes down $1, if the SPY goes down $1, this one would lose.
It would gain $1.
Gain $1, right? Very good. Trick question. This is another trick question. Are we bullish or bearish on short the market? This short the market ETF.
Right now we're bullish.
Yes.
Yeah.
So this ETF is designed to perform exactly the opposite of the market. The market we've just gone through is bearish. And so this, as the opposite instrument to the market, is bullish. And it just turns out that this security is liquid enough, meaning there's enough people trading it to where you're not at risk for what's called liquidity risk. Liquidity risk is simply when not enough people are trading shares and you end up getting bad fills by the market makers, meaning market makers make their money by stepping in the way of the money. And so they will, you've heard the expression bid and ask price, right? The bid price and the ask price.
Yeah.
Yep. Well, market makers try to make as much of that difference between what sellers sell an instrument for and what buyers pay for. There's a spread always. You can find that spread by looking right up here. So the SH finished Friday at 1602. However, you'll notice that if you were trying to sell the stock, The market maker will fill that sell order for the bid price. He will bid or she will bid underneath the actual mark of the security. You see that?
Yeah.
So you'd lose if you bought and sold the security within a second, assuming the price doesn't change. Would you get all of your money back?
No, you would lose about 7 cents.
You lose 7 cents a share. And also and right now this is kind of odd. You don't normally see this, but there's a reason you're seeing it like this. What does this tell you? Why is this like, you're not going to know the answer. I'm going to be a little bit rhetorical here. Do you notice that the ask price is actually below the mark price of the instrument?
Yeah.
So that happened because these trade after hours. So the market closes at 4:00 Eastern time. These securities, the SPY and I guess the short instrument, although I don't think it trades after hours, it'll reflect the opposite of the SPY price. And so what this is telling you is that in additional after hours trading, the SPY the SPY looks like it rebounded a little bit because this one finished a few cents lower than the closing price. That's what this means. So the bid-ask spread is lower than the mark price. That simply means that something happened after hours.
Got it.
It's only 7 cents.
Yeah.
Okay. But you can see how much liquidity there is on this instrument. That's 49,478,650 shares that exchanged hands on Friday alone, to show you how liquid that instrument is. Now we compare that to another instrument like, let's see. Why don't we do SRS, ultra short real estate. You see the volume here. So this is basically taking the real estate market and shorting it. And look at the volume difference here. Can you read that?
Yeah, I can see that. Yep.
250,000 shares.
Yeah.
So still pretty liquid, but not nearly as liquid as this one.
Yeah. Yeah.
So when you're talking about short ETFs, before you even consider trading them, make sure that there's at least 100,000 shares, preferably 1 million behind it. A beginning trader like you will want 1 million shares.
Yeah.
And this is 49 million. So good enough, right? Let me give you one more. SDS. This is like short, but it gives you $2 for every $1. So for every $1 the SPY goes down, this one would deliver $2 to the upside.
Got it.
11 million shares. That's pretty good. You could trade that.
Yeah.
Yep. So you want to look at the liquidity, and 1 million shares or more on the short ETFs. Okay. All right. Let's go back to charts and let's talk about some trading signals here and see what we got. All right. So just a little review. Are you bullish or bearish on the short ETF in the longest time frame? Or maybe tell me what cheat sheet factor number 7 should say.
It would say very bearish.
You are correct. And I almost corrected you. No, actually, you're not correct. It's at 24. So it is
24.
24, it's bearish, right? Below 20 is very bearish.
The yellow line?
Yeah, the yellow line is at 24.
Oh, okay.
It probably doesn't look it. You probably just looked at the chart. But if you look up here in the upper left, when I take that, you'll see it's 24.68. Okay. That's where you can find these. Okay. So I'm not going to strike you against. I think you knew exactly what you were doing. Okay, so that means that the longest term time frame, we haven't gone down enough to turn the longest term time frame. But that means you would be short the market for months to years. Mm-hmm. Do you care about being short the market for months to years?
No.
When you're short the market, just remember that for what takes 5 years to go up takes maybe about 18 months to go down. It's bear markets are short and fast. And so the long-term time frame for any instrument that is short the market or that benefits from being short the market, you kind of want to discount the yellow line altogether. That's what's different about regular stock trading and these short ETFs, okay?
Okay.
So just remember, the yellow line means less in short trading.
Got it.
Okay. Doesn't mean it means totally less, but it means as long as you're short for days to weeks to maybe a month or two as your time frame, then you can ignore the yellow line. If you think the market's going to go down for a year and you want to trade based on the the signals of the market forecast, you include it. But if your time frame is purposefully short, you can kind of discount factor 7. I'm telling you and every subscriber, short trades, discount factor 7. Okay. So the intermediate term, the one we care about, at 77.91, are you bullish or very bullish? And point it up, bullish or very bullish?
We're bullish because we're not quite above 80.
That's right. Okay. So we have an intermediate market posture that says for the next couple of weeks to maybe couple of months, the path of least resistance is most likely to the upside for SDS. Let me go back to SH. It's going to say the same thing, but let's deal with the 49 million element instrument. Okay. And we're at 79.53 for what it's worth on this particular instrument, but still we're bullish. All right. And almost very bullish. And what is the market forecast doing here? Wow, the long-term sentiment is actually almost looks bullish, doesn't it?
Yeah.
Let's see. 27.32 to 27.39. Actually, it's curled up in just the last 2 days. So I said you could discount it, but man, when it's trading in the same direction, more powerful. Remember what I said about risk? You could feel comfortable doing, if you wanted to, full risk on this short trade just based on that. Okay, so now the intermediate time frame is bullish. What about the blue line? Now remember, the rules are different. Let's review the options here. Right now we're on SPY. Let me find it on cheat sheets here. Here we are. On SPY, remember we're going to be the opposite with SH. Yep. Right now we're neutral here and in the danger zone here, which means we're in the bullish zone on the near term in SH, and we're neutral here. So that's a pretty good position to be in.
Yeah.
Okay. So we don't have a trading signal yet on this instrument, but let me go over what needs to be in place for you to feel comfortable. All right. Number one, you'd prefer this in a perfect world, but you're going to be happily to live without it. But you get a neutral plus or greater reading on the market sentiment line, you're feeling really good about a bullish trade. Okay, even if it's on a bearish thesis. Okay. You got the intermediate line, bullish or very bullish. Check. Okay. Now neutral plus, that's okay too, but a neutral plus line means there's probably a better chance of, or let me put it this way. There's as good a chance of failure as not failure when we're below 50 on any of these lines. But above 50 with this line neutral plus, that's optimal. Okay. But as long as you're above 20 and rolling up on the green line, you can at least consider the trade. Just know that if you get to 50 and you're rolling up, your odds of success are just greater because, again, what does an oscillator do? The higher that oscillator, the more the market is accelerating, because these oscillators are not a measure of price. They're a measurement of price velocity over each of the 4 major time frames. So above 50 just means that you are going faster. You know, the market is driving faster. And it's harder for the market to get passed by the shorts, for example. Okay, right. So above 50, you're feeling really good about a trade. Below 50, as long as you're above 20 and rolling up and you have market sentiment. I would say it's more important to have market sentiment at neutral plus if you're below 50 on the green line. You want that kind of that extra directional assurance. Does that make sense?
Yeah.
Okay. So now let's get into signals. The first thing I'll tell you is that whenever the blue line manages to get above 80, that is confirming price at that moment. And so even if there is no signal, and there is no signal on cheat sheets for shorts today, at least not any that I include, I can tell you that there is a different signal called a breakout trade. And I'll go over that. And so what's important for you to know is blue and red lines can act as confirmation or negation of what you see on the charts. All right. So here on the charts, remember how we showed you how the S&P was breaking down from a support level?
Yeah.
On Friday, remember that? There was a gap lower and we had a bearish engulfing pattern?
Yep.
All right. So on this chart, we had the opposite. Now, again, it's a very short-term breakout. but it is a breakout nonetheless. So we hit our head on this high. And remember, there's a lot of touches here. And I could go back. It may not perfectly line up because this is an inverse ETF. And it doesn't line up perfectly. But at least on the daily time frame, touch here. Daily time frame. Touch here, acting as resistance. Mm-hmm. Touches here and here, acting as support. Touches here and here, roughly acting as resistance. So a pretty good line in the sand. Would you agree? The more touches, the more likely it is to be a key inflection point for stocks.
Yes.
Okay. So to be honest with you, whenever you reach an inflection point, the assumption that a trader should have going to that inflection point is failure. So in other words, the path of least resistance whenever stock moves to an inflection point is that it doesn't pass through, it falls back. So the trader who is convinced of a breakout needs to have some evidence other than just price breaking through the line and or their gut. So right now you got price to break through. Now, although you'll notice that price broke out, but it traded lower. How do I know that? How do I know that price started higher at the beginning of Friday, but ended slightly lower?
It's a red candle.
It's a red candle. So the top of the candle represented what?
And
I don't mean the wick. I mean the top of the body. Excuse me. Top of the body.
That's where it started trading at.
That's right. That was the opening price. So it gapped up at the open. That's what that refers to, meaning there was no space. There was a slight space in between yesterday's close and today's open. That's called a gap. Okay. So it gapped higher, and then it sold. What price did it close? I mean, I think you can tell me what price it closed at, but tell me, where is that closing price on the candle?
Below the opening point.
It is below, but is it on the wick, that little skinny
the
bottom, or is it on the body?
It's on the body.
It is on the body. That's correct. Red candle filled in by red. Opening price is up, at the top of the body. Closing price is at the close. So what we would say about this one is that it broke up and gapped open, and then throughout the day it came back and what we call filled the gap. It didn't completely fill it, but it filled in some of the gap. That's actually a bullish sign, believe it or not. Coming back and occupying space between stocks allows it to then move forward in the direction you want it to move in. So a little bit of a gap filling, what's called a gap up and backfill trade. Now, what about these? I haven't taught you this yet, but what do you suspect the meaning of these little wicks are on the candle?
Is that what the possible gap could be for the next day? Or
no, that's a good thought, but it's actually simpler than that. This is the high for the day. So some point between the open and close, the stock traded up to this level, and then what do you think the lower wick means?
The lowest point of the day.
Right, intraday low. Exactly right. So the story you would tell about this stock, this is the short, the S&P. It gapped at the open, and then it actually reached a high of 16, 17, and then sellers came in and sold it down to a low sometime intraday. Before the closing, it got as low as $15.99. Before the end of the day, though, some buyers came in and bid the price back up to its closing price of $16.02. And that's what that story of that candle tells you. And then what does the story of, again, the last few trading weeks say? Well, let's start up here. Stock bounced off of a double top, meaning it matched its price here. It fell through support. So it held up, but then fell through support.
Yep.
Support then acted as new resistance. We trended down, and we trended back up, and we hit our head on what was support. But once again, for the second time, it acted as resistance. It fell back down. This time we hit our head on what was support at one time, now as resistance. But what happened on Thursday, Friday, we gapped up, and the gap, meaning the price held above, and we closed higher than resistance, right? So we effectively broke out. That's what's called a breakout.
Yeah.
Now, breakout trades don't work out all the time. And some traders don't like to take a breakout trade. What they like to do is wait for a retest before they get involved in the trade. when it comes to anything short, I don't like to wait for a retest. And what do I mean by retest? Let me see if I can find you an example of a retest. I'm going to have to show you an example to the short side. Okay.
Okay.
So here, after 2 touches, where support held, right?
Yep.
Held here, price came up, came back down, support held, price came back up. Third time, we broke down through support at a slightly, now if you compare it to past pricing, because we didn't know about this, right? We only knew this. You'll notice here that when we broke down, that if you compare it to the left-hand side of the chart, would you agree that it's probably in the upper end of the volume range if you just look at the volume that came before?
Yeah.
Yeah. So it doesn't look like it now because the average volume is picked way up, but it was on higher than average volume. Might not be 150% of average volume, but it was at least the upper end. There was some volume that supported this. Oh, and then let's look at the market forecast. Look what happened here. On that breakdown, a couple of things happened. One is it wasn't right away, but this bad boy came down here. So this is the red line. It wasn't the blue line that did this, but remember what I said, red or blue line, making an outsized move will oftentimes confirm something. Mm-hmm. Here, the red line traded down to about 2, the momentum line, the day before. Okay, so that was a tell that this breakdown was going to occur. And then actually we actually did that here. We popped back up, and then the red line came right back down again below 5 on breakdown day. So that kind of confirms the breakdown. So here's your takeaway. Red line more often than not, but blue line sometimes too, confirms breakouts or breakdowns. And so with a red line, you have a higher bar than a blue line, okay? For the red line, if you get a move below 5 on a breakdown or above 95 on a breakout, that is a high confidence event. You want to look for a support line that has a number of in-common touches that's been breached. You want volume to at least be better than average, but preferably 125 to 150% of average trading volume. Those are, by the way, indicators you can put on your charts as you get more comfortable. I'm not going to stop down to teach how to do that today.
Yep.
But so breakdown, breakout on high volume confirmed by the momentum line, which is factor number 10 in cheat sheets. It will say danger zone or the bullish 90 zone for the very bullish or very bearish would be the indicator on the red line for what I'd call a very strong signal. So a strong signal above 95, below 5. Okay.
Right.
Now, there is another signal that's good, but not quite as good for the red line. The red line above 90 or below 10 would be bullish or bearish. So in other words, it's a little different than the readings I was giving you before. Remember, for the senior time frames, bullish was above 80 and bearish was below 20, right?
Right.
Okay. And that's actually the same is true for the blue line above 80, bullish, blue line above below 20, bearish. Okay.
Got it.
But the red line is different. You want it to hold it to a higher bar. So very bullish, above 95, below 95, below 5 or above 95. Confirms a breakout or a breakdown. Above 90 and below 90 is what I'd call a standard trigger. So it's still a confirmation, but it might not be quite as good a one, meaning the failure rate tends to be a little higher. Okay? Got it. So how do traders work around that when they get a standard as opposed to a strong confirmation? Well, some of us will do something called sell option premium to lower our cost basis. We're not going to get into that today, but that's one of the ways I handle a breakout trade is that I hedge a portion of the trade to go against me. But there is a second thing you can do besides half the risk, and that is you can put half of the trade on the breakout and wait for what's called a retest before you put the other half of your money to work. That way, if there's a failure, you're not going to lose as much as you would if you end up winning. Does that make sense?
Yeah, that makes sense.
So let me show you I'm going to show you a retest that worked out, and it's right in front of you here. It's here. Okay. So we first hit our feet and bounced, but then ultimately we failed. at higher relative volume and with the cheat sheet, factor 10 at very bearish or bearish, confirming it. Standard signal or strong signal. I don't know which is each. But you'll notice we kept going down. Then what happened?
Started to go back up a little bit.
We reversed. That is called a throwback. A throwback or retest. You'll often hear me say throwback, retest. Very common. Okay. After a breakdown, to get a throwback where you retest old support as new resistance. Doesn't happen all the time. In strongly downtrending markets or strongly uptrending markets, it might come back a little, but it never makes it all the way. Just know that there is always at least somewhat of a move, either sideways in a really strong market or a strongly bearish market in this case, or you get a full retest like you got here. All right. So the way to trade this is put half of your money to work on the breakdown because you didn't get a strong signal. You only got you actually did get a strong signal. You notice that the market forecast momentum line is trading below 5 on the breakdown day. Do you see that?
Yeah.
Yep. So you could actually put all your money to work if you wanted to. As a new trader, I think I'd still recommend splitting it in half just because nobody likes to lose money when they're first starting out. And this is a way to lose less and end up making more. Consider it training wheels. Mm-hmm. All right. So you put half of your money to work on the breakdown and then the throwback retest. Well, how do I know when to get in, Mike? Because if I do it here, what's to stop me from the price keep on going and I'll lose money? You're absolutely right, Cole. What we want to wait for is what's called a bounce. And there are bullish bounces and bearish bounces. A bearish bounce is when we trade below the low of the high day. Okay. What do I mean by that? Well, this was the high day in the counter trend, right? Mm-hmm. This line, right? This candle right here, right?
Yep.
So in order for us to feel good about a bounce entry, we just need closing price on this candle. Remind me, where am I going to find closing price on this candle?
On this candle, the closing price is the bottom section.
Bottom of the body, right? The other way to get at it is just put your pointer here and then look higher, and you'll see in the upper left-hand corner. I'm going to point it out to you here. Watch when I put my cursor on the candle. You'll notice that the 7/27/2022 opening price was 15.75. That will correspond to the upper body of the candle. The high was 15.77. That's going to be the upper wick. Yep. The low 15.42. That'll be that lower wick, and the closing price would be 15.48. Okay. So that 15.48 is what matters most, and it needs to come in for a short trade that's a retest. What's called a bounce to the downside. Mm-hmm. You need the close, that part of the candle, to be below the low of the high day, meaning the wick of the high day. If there is no wick, then it's the closing price, right? There's actually no wick on the day before. Do you see that?
Yeah.
So it would be the lower body of the candle in the absence of a wick. That's your entry signal. That's called a bounce entry. And it's really important to know that one. It is one of the most common entry signals. When you're in an uptrend and you've pulled back a little bit and we get a bounce, that's a very valid entry signal. It's called a bounce entry. This happens to be a bearish bounce. Breakdown, throwback retest, trade below the low of the high day. Enter on this candle right here. Would that have worked out?
Yeah.
Yep. Now, it would work out only if you were short the short. You probably wouldn't do that. You'd probably go long. Yeah, short the short would means you're basically betting that the market goes up.
Yeah, wouldn't that just be the same as
the spot?
Betting on, yeah.
Yeah, exactly right. But I'm just, obviously, this is true for any stock.
Yeah.
I'm not going to teach you a flag trade, but that's a similar cousin to the bounce entry today because we want to get going on the market forecast symbols. Okay, so that's how you deal with a breakout. So tomorrow, if you decide, and again, I haven't given you a cheat sheet signal. This is called a breakout signal. It's just too hard for me to do it on cheat sheets. But that's where you trade above resistance on high volume, and you're pretty convinced this is a true breakout and not one subject to failure. Now, what happened with this is that you got the blue line above 80, one of two possible signals that works. Okay, you didn't get the red line above 90.
Yeah. And
that might be a stopping point for you. I can tell you that on cheat sheets, we will accept blue line above 80 or red line above 90 either of those two things as a confirmation of a reversal or a breakout. That's just, or a continuation. And in fact, on cheat sheets, I use that. So blue line above 80 or red line above 90, and you may want to say 95. Just realize red line above 95, there's nothing stronger than that. That's the best confirmation signal there is. But red line above 90 or blue line above 80 are about comparable. Okay. So this was in fact confirmed. This breakout was confirmed by the near-term line hanging out above 80. Okay. If you're not comfortable going all in with this one, you cut your risk in half, hoping you get one of these that doesn't go like that, because that's always possible. So what you want to do is set your stop loss just below this support line. Now, I haven't taught you the average true range technique yet. So for now, a beginning trader can set a stop loss between 1% and 2% below support.
Below what?
Below support. You mean we're going to assume this is acting as new support, right? So let's go through the exercise. The exercise is that you're going to, let's just assume for argument's sake, you're going to be able to enter Monday at the closing price that you got today. The chances of that, I don't know. Now, if you gap lower on Monday, you're not going to take the trade, right? So as long as you finish, as long as you enter at a price that's higher than the lowest point of your candle, the body of your candle, I think you're good to keep going. Some traders will wait and demand that price actually get to 20 cents higher than the high of the previous day. They just want that extra confirmation that price is going to continue to move higher. Okay. I think that as long as you've confirmed and have high confidence that this is in fact a breakout, I'm okay with not waiting for that level of confirmation, but every trader is different. Mm-hmm. Just know that maybe a standard way of doing it is the day after a breakout, you need more convincing. And so you require the stock to trade. It doesn't have to close this way, but it has to trade at some point intraday 20 cents above the high of the previous day. So that would be 20 cents above the upper wick.
Yeah.
So upper wick, will be what's called the high, H. So it's H price. So one entry technique would be, I am going to trade at 16.16 plus 20 cents. All right. So how do we do that? Let's go to a market order form, and I'll show you exactly how to enter that. Let's see, trade. How about that? Single order. Okay. So what I'm going to do is I'm going to set up a single order, and I'm going to give myself two contingencies. Okay.
Okay.
So what I'm going to do is I'm going to do a single order first trigger sequence. So the single order is going to then trigger. Let's see. Hold on. Apologies. I got to buy. I got to hit the buy signal. All right. Here we go. All right. Let me just delete this. I don't know why that's there. Okay. Sorry about that. Okay. So what I'm going to do is I'm going to buy first trigger sequence. And what that means is that once this gets filled, another order is going to get placed. Okay. And we'll talk about that other order in a second. So we're going to pretend that we're buying, just for now, we're going to buy 10 shares. I'll show you how to position size in a minute. All right. So we're going to buy 10 shares. What we're doing here is this is a very particular type of order. What you're asking for is for this stock for the order to fill, not until the price gets above 16. I guess we called it, what was it? High. It was 16.16. So it would be above 16.36. Okay. Yep. So what we're going to do is this is called a buy stop order. So this is kind of a weird thing, but think of it this way. You would use a buy stop order if you were short a stock. And if you're short a stock, you don't want price to go too high. And if it does, that would trigger a stop loss. That's where the name stop comes from.
Got it.
But you're buying not to close, you're buying to open. So we're using what's called a stop order, which simply means that you are demanding that the market trade at 16.36. And I'll tell you why I did that in a minute. Above 16.36 between sometime during regular hours. But it won't fill unless it gets to that level. Does that make sense?
Got it. Yep.
Okay. Now, this is something that I've learned to do recently. If you bid at the mark, there's a problem with that. The problem is, and this is something new, and I've gotten burned, and it's cost me $1,000 when I got burned. One time I was able to bitch about it, and I got my money back. The second time, it was like, you should have learned your lesson the first time. But what I'll tell you is that if you do this, what happens with an instrument that trades after hours, and this one may have a short window where it trades, where it opens for after hours trading before market hours. And what happens is that tends to be a really illiquid time. And so in order to prevent you getting screwed by the market maker where they fill you, even though they know the price is likely to go down, is give yourself that chance to only get filled if the bid price gets above 1636. Okay. That's really important. If you choose mark, you're opening yourself up to some market maker manipulation. You want to choose bid. And remember what that means. It means that this price, the lower end price, would need to make that number. Because what happens otherwise is these two can get inflated after hours. Suddenly there's a $1 difference between these two. And the market maker is setting his or her ask price at like $17 and their bid price, maybe at $15. But since you're saying mark, it's going to choose a midpoint between this arbitrary market maker price. And the only way to prevent that, the market maker will never do this because this is not to his advantage, right? Mm-hmm. The market maker will never jack up the price. So what I would say is, won't jack up the bid. He'll jack up the ask, right? For the market maker, this is the price he's willing to sell it to you. This is the price he's willing to buy it from for you, okay? So he's never going to sell it to you at a price that's below the bid. So that's why you choose the bid and not the mark, okay? Little trick. All right, so that's it. Now, we have to assume first that you're going to get screwed, okay? That you've made a bad trade and that this thing is going to come crashing down an hour after the opening bell.
All right.
So if that happens, we're going to do this and buy the dip and then call it a day. Okay, Cole, just so you know, Patriots, I know start in 10 minutes. Okay.
Sounds good.
Yep. We'll be done. All right. So we have to think about the worst case scenario first. Where is support is at 1598.
Yep.
Let's say, what do you want to trade this at? Do you have a calculator and can you run a number for me?
Yes.
Yep. So let's say we're going to set our stop loss 2% below the support line. So I need you to calculate 98% of 1598.
Okay.
And tell me what that number is.
It's 1566.
Okay. So what we're going to do is now we're going to place a contingency order, place opposite order, create opposite order. And what we're going to do is sell 10 shares at the stop price of, say again?
1566.
Okay, 1566. Okay. So the worst case scenario for you is you get filled intraday at some point on a breakout based on a market forecast confirmed breakout trade.
Yep.
Blue line bullish and the green line bullish is that you'll lose little less than $1 per share times the number of shares. Okay. So that's the worst case scenario. Now you don't need to set a price target. What you're going to do is just remind you got to think of a stop loss price once we get away from support. And there's a lot of things to do, and then we could do a whole course on this. But I'll tell you a good system to follow would be that that's your initial stop, and then assuming price moves in your direction, in the direction that you want it to go. We get the 18 to 34 moving averages back up here. 1040, sorry. 1040, okay. So right now, 1% below here. But as you start moving higher, at some point, you may want to transition to what we talked about last week, which is a 1 or 2 ATR stop below the 21-day moving average.
Okay. Yeah.
Okay. But for now, and until you get to a new high, right? You'd have to break above this level here before you'd worry about adjusting your stop loss. But on paper, if you were to set your stop loss, keep it there. Once you break above this level, you could actually move your stop loss up. Whoops, sorry about that. You could move so another way to do it until you learn the trailing stop method is you could keep your stop loss 1% or 2% below this line. But once you break out of this line, you'll move your stop loss up to 1% or 2% below here. Make sense?
Yeah.
And what you may want to do is, if you cross the halfway mark at 1637, you may decide, well, let me set my stop loss 2% below the halfway mark. That way, if the worst case scenario happens and the market reverses, I'll still book a profit even after my stop loss. Yeah. There's lots of ways to manage a stop. I just wanted to give you a couple of ways to do it to get you through until you learn more. Okay.
Right. So you can adjust them.
You got it.
That's the stop losses. Okay.
Yep. Now another strategy would be, and this is the thing we're going to close out on, is some people like to put half of their money to work on a breakout and then put the other half of their money to work on a buy the dip signal. So I'm going to do that as kind of the closing thing we talk about here. All right. So you put money to work. You're up here. I'm going to make these more important. Here's what needs to take. Here's what needs to take place for a valid buy the dip signal. And this is something you watch the market forecast for every day, or cheat sheets. We take the work out of it for you. In fact, I'll show you a buy the dip on cheat sheets after we're done. Sorry about this. It's not me. It's the computer doing this. So it's freezing up on me. Oh, shit. There we go. Come on. All right. So I'm going to find a buy the dip signal here. All right. So buy the dip signal. On cheat sheets, you'll need the green line above 50 before you get a buy the dip signal. But here's what I want you to know. If we're above 20 and rising in price, you could consider taking a buy the dip signal. I think I went over this with you last week.
Yeah.
Cheat sheets won't trigger one unless we're above 50, just because it's a higher probability bet for me, and I just want my clients to win. So it's deeper end of the pool to do it down here. I think the analogy I used before your Patriots game is that if you were to do it here, it's like having the ball on your own 1 yard line. Okay. Mm-hmm. So a lot easier to get sacked in your own end zone than to put it in the other guy's end zone. But above 50, at least you're playing in the offensive side of the field. And that's why I demand that. Okay. So what we want is green line bullish, rising and above 50 or above 80. Either will matter. Alternate signal, not mandatory, but it would be nice if this is at least neutral plus, meaning the line is rising and above 20. Even better if it's bullish, rising and above 50. Then you've got 2 time frames in agreement that matter to you. Okay. So what's the trigger? Those are the preconditions. The preconditions are you want the blue line to pull back to get, and unfortunately, I'm going to have to show you a different chart in order to see that. I'm going to choose the only stock I know that's bullish right now. It's the dollar. All right. And the dollar is actually flashing a buy the dip signal as we speak right now. So there it is, moving down in price. And a lot of times you'll see the buy the dip happen when there's a movement down in price. So the green line, is it bullish or bearish based on what we just talked about?
It is bullish.
Yeah. Is it bullish or very bullish?
Very bullish.
Yep. Now this line is not bullish. It's neutral minus, but remember what I said. You don't have to use the yellow line is your option. Okay. Mm-hmm. All right. So actually we don't have a buy the dip signal quite yet. Blue line, it's pulling down right now, right? It's and the blue line acts just like the senior time frames. So when I'm between 50 and 80 and rolling lower, what am I with the blue line? The neutral line? I'm actually neutral minus. Yeah, neutral minus. Okay. You actually want the blue line to get bearish. You want a slight pull down in one of the shorter term time frames. You want this blue line below 50. Doesn't matter which direction it's pointing in. It needs to be below 50, but this is most critical. It must be above 20. Okay. So when the blue line crosses below 50, but does not get below 20, that is a precondition for buy the dip. Okay. And the only other thing that's required is, remember what I said about that red line? When it goes to an extreme, it can be a problem.
Right.
So when the red line pulls down below 20, it's okay. Below 10, it's still okay, though I'd rather have it stay above 10. But anywhere between 5 and 15 is okay.
Okay.
Yep. So this will be a buy the dip signal tomorrow if this blue line gets just below 50 while the red line is down here around 23. It'll be a fine buy the dip signal.
Right.
Okay. So that's what's required. So you must have an established uptrend. That's critical. That's usually with the green line doing what it's doing, right? The green line is bullish and above 80, very bullish and above 80. On cheat sheets, it will say bullish or very bullish. And the blue line will say neutral minus.
Right.
And as long as this doesn't say very bearish, red line doesn't say very bearish. So indicator 10, it can be anything except very bearish. We'd prefer it not to be in the what we call the heads up zone. I put something in the heads up zone when it's below 10, but above 5. Okay. Below 5, it's considered very bearish. It's called the danger zone, the bearish danger zone in cheat sheets. Between 5 and 10, I call it heads up. Still okay to take it by the dip. It's just a little bit more risky. And anything, any other place on the chart, it can be. It doesn't matter as long as it's not below 5. Blue line below 50, but above 20. Green line rising and above 50 or above 80 in any direction. That's all that's required for a buy the dip signal. Here's a buy the dip signal that worked out just perfect. You'll notice you got into it the day before a bullish engulfing pattern. You see that?
Yeah.
So here it is. So is the green line bearish, bullish, or very bullish? And I'm pointing to buy the dip is here.
There it is, very bullish.
Correct. Okay. And is the blue line bullish or bearish?
The blue line is neutral minus.
Correct. And is the blue line in that zone between 50 and 20?
It is.
It is. And the red line, is it doing any damage to you at 12?
Nope, not quite.
Perfect buy the dip signal. Look what's happened since.
Gone up.
Notice how we put a stop loss here. This is the 21-day moving average, just so you know. This is another way you can do it. And then this is what's called a Keltner channel, which I showed you how to put on your charts yesterday. And it's, this is a 40-day moving average. And this is 1.1 ATR below the 40-day moving average. So that's a setting if you want to hit screen grab. This is not a bad setting for this type of trade, for the short trade that we're just talking about.
Yeah.
Again, stop losses are nuanced. There's certain ones I like. Probably I like this one for the longest term. So if you think the market's going to be in trouble for a few weeks to a few months, which I think is possible, this is a really good stop loss strategy. That would be 1.1 ATR below the 40-day moving average. And if you copy those settings and put that in as a Keltner channel on your trading platform, along with the market forecast, you have yourself a damn good buy the dip trading system. So I tell you what, let's take 2 weeks off because I've given you a lot to digest over the last few sessions. But here's what I want you to do. I'd like you to determine bullish or bearish stocks and trade. Again, when I say bullish, it's going to be ETFs like the short market because you should only trade in one direction right now. Trade bullishly in terms of the direction you go, but you can use short ETFs. There will be a section on cheat sheets that will give you a bunch of highly liquid short ETFs with signals on them, or you can just go look them up on your own, or find some bullish stocks using cheat sheets or your own methods. But look for some buy the dip trades and send me a screenshot of what you want to take, and I'll confirm or deny for you whether I think it's a good trade based on our rules. And start trading. Don't worry about position sizing right now. Just buy yourself, if you can, buy yourself in paper money, $5,000 worth of any one stock, and don't put any more than about 50,000 to work. So the most number of trades you should take are 10 trades, $5,000 each. You got a $100,000 portfolio right now. You want to leave a little in cash. But that would be a good starting point for you, and build up to those trades. Don't force them. Let them come to you. Buy the dip only. Send me a few screenshots. Let's see how you do with determining what works, and let's see how you do. And then I'll answer any questions in email.
Okay, sounds good. And I should be looking for only buy the dip signals.
Yeah, I'll tell you what. If you feel comfortable trying a breakout or breakdown trade, because we covered that today.
Yeah.
There's going to be a lot of that over the next day or two. Unfortunately, most of it's going to be short. This is not a good time to be trading bullishly, but I will send you a list of short ETFs. Okay.
Sounds good.
All right. And cheat sheet subscribers, once a week, you get a free premium list. And so I'll send that to you guys too. And I'll try to make today's session. I've got a cheat sheet that I owe everybody. I'll put some short trades in today's cheat sheets that I'll send out before the end of the day.
Awesome.
All right, take some trades, Cole. The more you take, the better, but don't force them. And then when you're ready, a couple of weeks, 3 weeks from now, give yourself a chance to actually put some trades to work so you're comfortable. It's one thing to sit down and listen to me talk for an hour nonstop. It's another to do this stuff. Right. And it's okay to fail. You're failing on paper money. This is the best way to learn.
Right.
Let's see how you do.
All right. Sounds good.
All right. Good catching up with you. And thanks everybody who followed along. And cheat sheets, remember, go to stockcheatsheets.substack.com. Sign up for a free newsletter that comes out at least 3 times a week with buying and selling signals and relative strength analysis. It's a great way to start trading, or if you're an established trader, using this system will probably improve your game. Talk to you later.
Bye.
Thanks, Cole. Good luck, Patriots.
Go Pats.
All right. See you later.